Historically, the industry has focused primarily on cash flow forecasting. In some of the other videos, we've talked about the building. Always come back to real estate, and that's what this industry is about. And really, until this point, we've talked about two components of it: the revenue and the expenses. And revenue minus expenses, we avoid interest and tax considerations. We just keep things very simple. We'll get the net operating income. So effectively, our operating revenue minus our operating expenses is going to give us our net operating income. And by and large, historically, that's what the industry has cared about. Is this property making money on a monthly basis? Now, the global financial crisis is a great example of why that balance sheet component needs to come into it, and it touches on how organizations look at the returns of their building. So if we think about for a concept of if you're looking at investing in an asset, a real estate asset, clearly if it's making money is an important consideration. That's the revenue component by the expense component. And if we had to draw a graph of time over here, and this is the NOI, we would want basically a property that their operating income is doing something like that. Meaning, you're not gonna buy a property unless you have an ability to basically be able to increase how much money it's making. So there has to be some efficiency you can build into it, either reducing the expenses or increasing the revenue. But basically, you're going to be looking at increasing the performance of the income over time. And that, by and large, again, is how the industry has been looking at these real estate assets, looking at the performance of the income. But the global financial crisis has really brought to bear a whole other dimension of things that we need to look at. And that relates to really the value of this asset, so the capital appreciation of it. So if you think about us buying a house, we all at some point strive to buy a house, and the reason we do that is because we believe it's a good investment. The house is not going to give us any return. There's no income coming from the house, but we believe that the value of the house is going to go up over time, and there's going to be some return in that. So that component of the return has nothing really to do with the revenue expenses. That's got to do with the capital component of the return. And so organizations, when they're looking at buying real estate, they really do care about both of those elements. And so if I add to the graph here the property value, so let's say the value, different axes, but we'll just, for the purpose of this, draw it in the same graph, that the value could be somewhere here, and the value is going to go up and down. And then, like in the global financial crisis, the value really dropped through the floor. So we'll put here the value of the building. So there are different returns metrics which help us assess the performances of each of these elements. The one is, when we look at the return of this investment over time, we would look at the income return. So that's a metric you'll hear out there, but largely what the income return is looking to tell us is how effective our strategy for increasing the NOI of this property over time is. So since buying this, have we had an ability on being able to push up the income component by either increasing revenue or reducing expenses, or doing both? Again, that's really been where the industry has focused historically. So when we got the call from Oxford, what Oxford was looking at doing was really forecasting the balance sheet. And the reason that they were forecasting, not only looking at doing it, they actually had to do it. It's a requirement of companies, many companies in Canada, pension funds in Canada, to have to focus on the balance sheet component. But the reason they look at that is because the way that we measure the capital component, the capital appreciation, depreciation of the asset, is by looking at the metric called the capital return. So the capital return and the income return together makes up what we call the total returns. So it's basically the sum of those two elements. So if you think about where the industry was, if you're just focusing on the revenue and the expense side of things, all you can look at is your income return. You can't measure the capital return component. Historically, you can look at it, but you need to be able to forecast out a balance sheet to really understand the capital side of the return, and then how that's going to affect your overall returns. And I'll give you a couple of scenarios as to why you would care about that, because in this example where our income return is doing quite well, but our overall value of the property, the capital return is going down, the total return would look something, actually I'll draw it in here, the total return would be the sum of these two graphs. So it'd be somewhere like, going down. So over time, if you're looking at your total return, this is not such a great investment if you're looking at total return alone. If you're looking at the income return by itself, it's a good investment. You've had a good impact on improving the performance of the property from a net operating income perspective, but the value of the property's gone down, so your total return is not great. If we contrast that with another scenario, so let's say we have a property where the NOI, we buy it and the NOI goes down, yet we're fortunate to buy it in a time where our property value, let's say, starts there, and that goes up over time. So then our total return is going to be something more like that. So if you're looking at your total return, which is your combined return, it actually looks like, it's a pretty good investment. However, if you look at the operating is really going down, which is not good. That means on a monthly basis, this property is doing worse off than when you first bought it, meaning the team that you have in place that's managing this building is not doing a good job. Now, if you're looking at your total returns, which is this blue line, it could be masking the fact that that team is not doing a good job. You've been fortunate enough to buy that asset at a time where the value of the property has actually gone up. That's masking, though, the fact that the team that you've got on the ground is doing a poor job. So that's where the total returns are good and really completes the picture as to how you're managing this asset. And this was very much highlighted in the global financial crisis, where the property values basically halved, if not worse than that. So when you looked at the total return, it looked terrible, but you had to really drill down under the covers to say, let's separate out our capital component, meaning how much of this return is being impacted by the capital value, the building's value going up or down, and how much is it being impacted by our net operating income, meaning the performance of our team on this asset. And those are two very different metrics and two different perspectives, and they give you a whole other dimension that you should be considering when investing in an asset and looking at the performance of the team.